Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include a Fed retirement, my interview with MeridianLink's JP Kelly on how evolving credit score models, real-time analytics, and data integration are reshaping mortgage lending, and in the capital markets, what we saw from yesterday's 10-year note auction. In the mortgage industry, it's easy to assume everyone understands the process of pulling credit. After all, it's a standard part of origination. But many professionals, even those adjacent to lending, don't fully grasp the infrastructure, data flows, and participants involved in approving a new homeowner for a mortgage. Mortgage lenders choose TransUnion for their identity-focused, data-driven mortgage insights and solutions, enabling them to achieve more desirable lending outcomes in a volatile housing market. To learn more, visit transunion.com. In news, underwriters will need to know banks across the United States are taking Director Bill Pulte and President Donald Trump's 50-year mortgage suggestion and running with it. They, the underwriters, would now require an applicant's grandkids to co-sign on a 50-year mortgage, just in case, as part of the approval equation. I don't know if that's true or not. Did you come here to get the news, or... Well, it's better to have loved and lost than to never loved at all. In this case, and it's a bit of a stretch, I'm talking about putting out this podcast and the commentary without the usual 8:30 a.m. Eastern economic releases during the government shutdown. But it appears that things will crank back up, at least until January, when we may be going through this again. Wait a minute. The White House said yesterday that it was unlikely the federal jobs report or the consumer price index reports that were due to be released from October would be published after the government shutdown ends. Recall that Fed Chair Jerome Powell said on October 29th, quote, "If you ask me, could it affect the December meeting? I'm not saying it's going to, but what do you do if you're driving in the fog? You slow down." End quote. Well, we're on the Fed. Atlanta Federal Reserve President Raphael Bostic, he's the first black and openly gay person to lead one of the U.S. central banks, 12 regional banks, said yesterday he will retire at the end of his current term on February 28, 2026, an unexpected departure amid a push by President Donald Trump for more influence over the Fed. Remember that, despite tweets, Trump does not select presidents of the regional Fed banks, but the appointments must be approved by the central bank's board of governors, which the U.S. president is trying to reshape through the attempted firing of Governor Lisa Cook and the upcoming choice of a replacement for Fed Chair Jerome Powell when his term as Fed Chair ends next spring. That all makes me a little nervous, and here's a stretch of a segue. The NFIB Small Business Optimism Index slipped in October, marking a second straight monthly drop and returning sentiment to its lowest level since new tariffs were introduced in April. Also President Trump idea. While confidence remains above pre-election levels, many owners reported that limited labor availability, softer sales, and shrinking profits are dampening their outlook. On a positive note, hiring conditions have remained steady and fewer businesses are raising prices. Still, small firms continue to cite high operating costs, elevated borrowing rates, and sluggish demand as key pressures on growth. For today's interview, I wanted to welcome to the show MeridianLink's JP Kelly to talk about how evolving credit scoring models, real-time analytics, and data integration are reshaping mortgage lending, from improving credit inclusivity and compliance to accelerating decision-making and redefining competition in a data-driven marketplace. He's SVP of Mortgage at MeridianLink, where he's focused on improving the mortgage experience for loan officers and borrowers.
We're in the fourth quarter here. MBA annual was last month. It felt like hope springs eternal. It felt like hope sprung eternal. Hope is always springing eternal. I'll figure out how to conjugate verbs at some point. But we're entering kind of a fun time for the industry, at least versus what it's been the last couple of years. So I would say that because there's optimism out there. Borrowers aren't so focused on rate. But for originators or lenders out there, it's kind of like, holy smokes, I should have been focused on my tech stack when I had less volume to deal with. Now that there's more volume, there's technological wars out there, arms races, if you will, to capture borrowers. And so it's obviously top of mind for a lot of people in the industry about how to best hone in their tech. All that jumble mumble to say, how should lenders be thinking about and investing in their tech stacks currently as we near 2026 here?
Yeah, well, Robbie, first of all, thanks for having me on the podcast. I've long considered you one of the best hosts out there in the podcast space.
Thanks.
So we'll just start out right there. But yeah, I was at the MBA as well, and you're right. I did hear a lot of general optimism in the space on what we're looking forward to. I'm really hoping that it is what we're all hoping it's going to be. We thought this time last year we were kind of off to the races, and we had a little bit of a pause. So everyone's really excited about what 2026 brings. You're right. When things have been slower and it's been a tough, last several years, that is one of the best times to really look at your tech stack and determine when things pick up again, what's the best way to invest so that we can provide a better experience for our customers and be able to do it in a much faster, cheaper, more efficient fashion than we did in the past. If you remember during the COVID days, everybody was so slammed. People were at 150% capacity working overtime. Now's the time, and it's not too late. Now that we're right on the precipice of things getting better, I don't think anybody thinks we're jumping straight back into a COVID craziness. So now really is a great time for people to look at their tech stack and determine how they can improve their efficiencies. I think a mistake that a lot of people make is they try and bite off more than they can chew. They have this vision and they want to go, both feet into the deep end. We like to suggest that people map what we call a digital progression model and really break it down to and take an assessment of where do they sit today and start to break it into bite-sized chunks. Because I'm sure you've heard out there in the industry, everybody, when they bite off more than they can chew, they get bad implementations. They have false starts, meaning they start and then they have to stop and re-implement and go again. Whereas if you can get into break it into bite-sized chunks of what do you want to focus on first to improve your tech stack, and what does that journey look like over the next 12, 24, 36 months of how you can continue to prove and tackle it one piece at a time.
Two sides of the equation here that we need to look at. One obviously is the lender side of things. What can we be doing to offer the best processes? The other side is the borrower. What does the borrower want? What are they demanding? Because borrower expectations have shifted pretty dramatically. Personalization, speed, efficiency. That used to be getting a mortgage was like getting a root canal, and now there's expectations around the process. I want it to be seamless. I want to feel good at the end of the day. And for lenders, they want to give borrowers an experience that they'll get referral business as a result of. So we're seeing lenders, the real-time insights, borrower demographics, credit profiles, behavior, that's helping improve the experience. What are you seeing that's really helping kind of deepen these long-term financial relationships and gender loyalty, kind of the latest and greatest when it comes to meeting borrowers where they want to be met?
Well, a lot of what you talked about all comes back to the concept of data, right? Analyzing data. And data has so many powerful use cases. And we see the people that are being most successful across our technologies, they are looking at and understanding the differences in what different subsets of borrowers want, and making sure you have solutions. And that's being able to see where they are in using the customer facing technologies, for example, applying for an application online, et cetera, seeing how they're working through that journey in the funnel, monitoring where different people drop off, and then breaking that down into different demographics and understanding, Gen Z is going to want a different experience potentially than Gen X, and even down to gender and what have you. So being able to provide multiple paths that best suit the borrower looking to go through that journey and really customize and tailor it, you're going to provide a much better bespoke process for each one of those borrowers.
And you mentioned data there, so let me kind of dive into that, because lenders are sitting on mountains of untapped data. I've mentioned on the podcast in the past, mortgage companies arguably have some of the best insights into the general public or potential borrowers out there versus any other lending institution or financial institution. And there's a ton of value in that in this modern time. But financial institutions aren't turning in this real-time data into immediate action like they could in a lot of cases. What are the roadblocks or what kind of barriers or hurdles that are preventing this?
You see it with the big players. They're utilizing it like crazy. But when you get into the typical size, small to medium size financial institutions, you're right, they're sitting on a ton of data. And we have customers, we at MeridianLink, we have the MeridianLink mortgage as a mortgage solution, but we also have our consumer side of the house where people are getting autos, consumer loans, et cetera. And you're right, the mortgage process collects more data than any other lending process out there for the consumer. I think where a lot of customers struggle is they don't really know where to start. I mean, they're still managing by old school pipelines and doing it that way. They just don't know what should they be looking at. And I think the key is, and I've sold different, I've been part of companies that have sold different technology solutions in the past, and they're great and they can sell you a powerful solution, but they still expect the customer to figure out, to map out what do they want to look at, what are they trying to get to, et cetera. And I don't think most of them have that expertise in house, and that's where they struggle. We released at the MBA actually a new product called Insight for Mortgage. And it comes out of the box with customers and breaks it down for them and teaches them how to look at the different aspects of their business with charts, graphs, et cetera. Because data can teach them all sorts of things about what type of products different borrowers are going to be looking at. You can look at different parts of their assembly line in their mortgage manufacturing process and determine where are they struggling, where are they running into roadblocks, where do they have multiple people having to look at loans. So that way they can really look at and try and identify the inefficiencies that exist in their business and know where they have to focus.
Well, I appreciate you bringing up MeridianLink because I'm a little remiss for not mentioning them at this point into the interview. There's a recent acquisition. Centerbridge Partners announced the completion of its acquisition of MeridianLink. You just talk about what that means a little bit for the company, your offerings, and the overall ability to compete in the mortgage space.
We were super excited to be part of Centerbridge now. Essentially, it's not a large change in the company, who we are as a company and what we do. It's really just a change of ownership. We were a public company that had institutional investors, and now we're brought private again and part of Centerbridge. Centerbridge has a deep understanding of our business, and they have a lot of experience in driving growth in the financial sector. And one of the things I'm super excited about is being private again. When you're a public company, there's so much emphasis focused on quarter by quarter results. And now that we're private and we're part of Centerbridge, it really allows us to accelerate how much we're going to be investing in product innovation, because we can take a longer term strategy and start to invest and really enhance our digital lending capabilities across all of our MeridianLink product lines. So really excited about the potential of what that's going to bring for us as a company.
Yeah, I could tell you're excited about it. Let's look ahead, not necessarily pull out a crystal ball, but when you think about the data, the efficiencies out there, everything we've talked about today, kind of put it into a bow, peer benchmarking, integrated analytics. How do you see competition being redefined amongst lenders? I mean, recapture wars have been a big point of emphasis. Kind of how do we get to the customer first?
Utilizing data is going to be one of the big differentiators that lenders have to get on board and start to analyze. There's so much for you to maintain and get to your customers first. You have to maintain the relationship with them. It's no longer just a refi world and there's more business than you can handle. You have to establish the relationship with the customers. And by analyzing the data and looking at where they are in their financial profiles, you can start to identify when are they going to be looking to have another major transaction, whether that's a car, a home, based upon their credit profiles. If they've recently bought a home and you have all of that data, if you're a financial institution that offers unsecured lending, why not offer them an unsecured loan to be able to help them with moving expenses or remodeling expenses or a HELOC if they've been in their home X amount of time? You can start to look at that data and just continue to be in touch with them and be able to offer your services and stay close to the customers. And the best way to do that is to look at different customer profiles, and you can start to create your algorithms and reports around what customers fit into those profiles that are going to be best suited for you to be able to offer your next product to the customers.
And I should say, part of MeridianLink's whole value proposition is allowing originators to make smarter lending decisions. Any thoughts on kind of where we are with these different credit scoring models and changes we've heard about recently, how that shifts the landscape, or where MeridianLink fits in terms of these changes?
Yeah, we're monitoring those changes closely. It's a pretty big shift in the credit space, and we have Mortgage Credit Link is one of our products where we're the central hub for a lot of the credit transactions for mortgages that get ordered, and we're continuing to monitor and see how that's changing. But I think ultimately it's going to be good. There's a lot more competition with Vantage Score coming in, and you can start to analyze and take a relook at models that everybody's been looking at over the last 30 plus years in the industry, and really get an understanding of what new credit profiles we should be looking at as we move into the future.
Yeah, it is exciting times. I enjoyed interviewing you a lot. This was a real pleasure, and I'm sure we'll have you back on. So thank you very much.
Looking forward to it. Great talking with you, Robbie. I appreciate it.
In the bond markets, even after a brief dip following a weak $42 billion 10-year note auction yesterday, yields on 10 and 30-year bonds stayed below their recent averages, signaling steady demand. Today's 10-year Treasury auction was mixed, stopping at a 4.07% yield, below the 4.34% recent average. Non-dealers took a strong 89.5% share, while the bid to cover of 2.43 was slightly weaker than usual. Dealers bought less than average, directs bought more, and indirects were steady. Treasuries rallied before the sale, but yields rose afterward as the market cheapened. Today's loan data point is the October budget statement, with the Congressional Budget Office estimating a deficit of $219 billion versus $257 billion in the prior fiscal year. Treasury will announce next week's auction sizes for 20-year bonds and reopen 10-year tips before auctioning $25 billion of 30-year bonds. Freddie Mac will release its primary mortgage market survey. The prior week's 30 and 15-year mortgage rates rose 5 basis points and 9 basis points to 6.22% and 5.50% respectively, and 2 Fed speakers are currently scheduled: St. Louis's Muslim and Cleveland's Hammock. We begin Thursday with agency MBS prices roughly unchanged from Wednesday's close, the 2-year yielding 3.59 and the 10-year yielding 4.09 after closing yesterday at 4.07%. Let's wrap up with a joke and some housekeeping. The CEO of IKEA was just elected Prime Minister of Sweden. He should have his cabinet together by the end of the week. Thanks again to TransUnion for sponsoring today's podcast. Mortgage lenders choose TransUnion for their identity-focused, data-driven mortgage insights and solutions, enabling them to achieve a more desirable lending outcome or lending outcomes in a volatile housing market. To learn more, visit transunion.com.